Welcome to the Business Growth Masterclass, where business growth is made simple. Listen as we interview real business owners and learn from their wins, their losses, and everything in between. Today's guest is the founder and CEO of the Stellar family of companies, a regional firm in Texas that specializes in construction and management of multifamily assets or apartment complexes. If you want to learn how to navigate the highs and lows of that industry and the broader economy, this is the episode for you. I think you're going to get a lot out of it. Welcome to the podcast, Mr. Paul Stell.
Thank you for having me. It's awesome to be here.
I am excited. I don't know. I think I've told you this, but I'm going to tell you again. You were the guy that spoke into me and Tanner that encouraged us to get involved in this industry. And
it's been a while back.
It's been a while back. I don't know if you remember it, but you were the first guy to teach us what a cap rate is and how increasing income, decreasing expenses makes commercial real estate worth more money.
Well, don't blame me for getting you into the business.
That's one of those things I have never taken lightly. Since then, and there's been men and women throughout my life that have spoken into me in the moments didn't feel like big things, but later in life, looking back, was like, man, them saying that and just speaking into me really changed my life. And so
I remember that.
I wanted to bring that up because that's part of our story. And man, that's Lubbock, Texas. That's West Texas.
I love it because look how far you've come. And that's a story in my life and in so many people I know. The multifamily business seems to be that way, where people oftentimes are willing to share. And, one generation kind of brings up the next. And there's a lot of people who stand on the shoulders of people who came before them. I'm that way. And so, and look where you've come. So that's awesome.
Yes. I always tell, I'm involved in LCU, my alma mater, and I get to talk to a lot of college students and really can't stress enough how relational business is. And when you care about people and develop real relationship, that's just how business is done. All right. Enough of gushing over each other. What can you tell? I gave a brief intro, but tell our listeners what is Stellar family of companies? What does that even mean? What do you guys do?
Yeah, sure. We are essentially, what the industry would call a private equity real estate investment and development firm focusing on the multifamily sector of the commercial real estate industry.
Okay.
Yeah.
So
kind of technical answer there. So we're in the apartment business, and we have a number of businesses that do work in that space.
Yeah, give me a lay of the land. So it's a family of companies.
Yeah.
And so how do you have that divided up?
Yeah. So over the years, we started out in 1989. We focused on trying to find apartment properties that were underperforming and purchasing those assets and trying to make improvements to the business of that property, which is measured in, your revenue minus your expenses, NOI, net operating income. And so oftentimes it was a physical improvement to the asset and operational component to it too. And so we started acquiring assets in 89. We started managing alongside of that. And just over the years, we've evolved where we have 5 primary functions. First is our Stellar Capital Partners, which is our investment arm. Mm-hmm. And through those 35 years, we've worked in, I think it's like 26 markets, 4 states, but we love Lubbock and love raising my family here. So we get on the company jet, Southwest Airlines, go where we need to go. And so over the years, we look for assets and we've bought and owned and assets in a lot of different places. And so first, Stellar Capital Partners is our acquisition investment arm. Stellar Development Company is the arm where we develop new properties from ground up. and we've been very active in that space. Third of the five arms is Stellar Construction Company. We're a general contractor, so we build our own properties, and then we also build for other third parties. Um, Fourth is our asset management arm, Stellar Asset Management, of course. And lastly, Stellar Communities, which is our management arm. And so I like to say we're maybe an inch wide, but a mile deep, highly focused on multifamily space, heads and beds. But we've got a very narrow focus, but deep commitment to it.
All right. 1989. I did not know that you've been at it that long.
Yeah. Right out of college. It started for me when I was young. I don't know why, but I drew a lot, and I drew buildings. I think it's because I had to draw straight lines. I couldn't draw, couldn't be, animals and people. But, and then even in junior high, your parents say you draw, and they say you got to be an architect. Made sense to me. High school, I take drafting courses, and I win a state competition with a set of house plans. I think I'm an architect. So I go to tech originally to be an architect, go to architecture school. But then I was entrepreneurial, and I had a business, and I had it all the way through college. And after a year in architecture school, I realized I was more interested in business than architecture. So I switched to business school, finance, started taking a lot of real estate courses. And at the time, real estate was just this great topic I loved, but I had no idea how you could actually get in it. Had a business through college. I sold it my senior year.
What kind of business?
I had a cleaning company, and so we would run around and clean buildings and homes, and we had these little vans that run around with crews in them. And so they'd show up 7:00, 7:30 to office, and we'd get them off on their schedule. And I'd go to class with my pager if they needed me. They'd pager me back then. And then when I got out of class, I'd go find whoever's running behind schedule and help them catch up. And so didn't make any money hardly on it. Taught me a lot of things I don't want to do in life, but it was a tremendous experience. Learning to deal with customers, employees, and everything. But nevertheless, I sell it, make just enough money to live my senior year without having to work. And I had a best friend who had come to town. He graduated a couple years before me. He was a pharmaceutical rep. We're having dinner one Friday night at Chili's, and he says, "Hey, I've joined a club called Toastmasters. You ought to come to it. Toastmasters help you learn how to speak in public," and I wanted to do that. So I said, "Yeah, let's do it." Meets Friday morning, 6:30 in the morning, in the basement of a hospital. And so the only people showing up at 6:30 on Friday mornings to learn how to speak in public are motivated people.
Yeah.
And so 20, I don't know, maybe 25 people in the club, and they were the best people. They were motivated. They had some nurses, doctors, attorneys, accountants, just a cross section of people. One of the first times I was there, someone got up and did a little speech, and his man named Steve Hurt. And somehow in his speech, he referenced what he did for a living, and he was in the development and investment business, real estate. And it was like falling in love at first sight, hearing it. And I just thought, I felt like his divine moment. And so I went up to him afterwards and, introduced myself. I was 21, I think. And I asked him if I could take him to lunch and just learn from him. What does he do? And have him explain it further. He was gracious. He took me. He was 40, probably 40, 41. And so we go to lunch, and after he talks to me, I'm hooked. I like to say I took to it like drugs, but even though I've not done drugs. But I mean, I was taken, I found my calling. And so I come up with an idea because I've always been kind of a salesman. And so I chased him for a few weeks to get him to go to lunch with me again, a second time. And I say, "Hey, would you let me come hang out with you, work at your office for free? You don't have to pay me. I'll take out the trash. Hey, I can clean your office for you for free. I know how to do that," and just whatever. My thought was, I just want to be around this guy to learn. I had never heard of the term internship, but essentially that's what it was. And he said, "Yeah, come on." So every day, every moment I wasn't in class, I was at his office, and I just followed him around. I committed to follow him with reckless abandonment. And luckily for me, he was a wonder and still is a wonderful man and one of the top 5 men in my life. And he ends up hiring me when I graduate. And then we eventually become partners, and the rest is history. So that's how I got into business. And so I'm a product of someone being gracious to me and generous and sewing into me and teaching me. And so I stand on his shoulders, and I'm very grateful for that.
What a great story. So you grew up in Lubbock.
I did.
And just so happened to find this guy in Lubbock, Texas, of all places, to start your career in multifamily in the late 80s at the turn of all the savings and loan
Yes.
mess debacle that was the mid to
Yeah.
late 80s. And that's where your real estate
Could have
career.
been any better timing. You could really not buy anything wrong. I mean, if we knew what we were doing then and had not had all the guts in the world, we should have bought everything. But he was one of the few guys that went through the crash and didn't go bankrupt. So he was kind of shell shocked. He was very conservative. That's one of the reasons he didn't go bankrupt during the crash. But the people that weren't around don't realize in '86 you had a total collapse of the oil business in Texas, the real estate business from the Tax Reform Act of '86, and then the banks started collapsing, and the whole entire S&L business industry went away. The FSLIC,
SNL, what's that?
savings and loan.
Yes.
So they went away. The FSLIC, I think, got merged into FDIC, and then FDIC had to kick it over to something called the Resolution Trust Corporation, RTC. It made the GFC in Texas look like a blip. GFC doesn't touch what it was like. And so into that chaos, I come after all the damage had been done. And it was just very, it was fortuitous, for me to land then and have someone like Steve. Steve had a great record. He had lending relationships where he could get loans when other people couldn't. And, it was off to the races. And I've been blessed ever since for it.
That's one thing, especially in macroeconomic times like today. Today we're in another one of those, short-term or maybe long-term debt cycles where it's hard to get loans. It's hard to buy properties. And a lot of our commercial real estate industry is reeling and not thriving right now. And having those relationships with those lenders, because right now, properties might be in foreclosure, they might be on sale, but buying them and getting the loan is a completely different thing. It is difficult to do that, even though you're buying at a discount compared to where it was 3 years ago. Getting that loan takes a track record, takes a relationship, and
more importantly, investor equity takes that.
It does.
The industry has changed phenomenally since I got into it. Of course, I think there was no internet. Everything was sent, fax. That was kind of the top of the technology, pyramid at the time. And there was no data. And so you would get something in the mail that says a property's for sale, and it'd have a price on it. And there were very few buyers. The apartment industry was still seen kind of as a lower class of commercial real estate. The pension funds and insurance companies and so on. They were in high-end core assets in downtown, office towers, things like that, malls, and large regional shopping centers. And multifamily was considered kind of below par for them. It wasn't through the GFC that the industry started realizing how strong and how good an asset class it was. But so it evolved, and after the crash of the mid '80s, you had this huge transfer of wealth. You had all this money from the New York and stock exchange. You had the REITs really came into their own, whether it was a mortgage REIT or an equity REIT, and that capital brought a huge amount of sophistication to the business. And then you had the confluence of that with technology, the evolution of the intranet that came out, and then people started tracking data. They started putting that data on the internet, and all of a sudden, you today can subscribe to different services, and you can pull up any property anywhere in the country, and you know everything about it, down from its amenities, its rents, its occupancies, who owns it, what is the debt, all of that, and that information flow transformed itself also into offers. Instead of a fax machine sending out to 20 guys with a price on it, now it goes out in an email to 5,000 or 10,000 buyers. Everybody gets the information at once. And so the market has become tremendously more efficient.
Yes.
That's squeezed excess profits. So the industry is much more competitive. And so it's a different kind of business as it was back in the 90s, so to speak. And so everything evolves.
Yeah, that was so well said. That's exactly where I was going to say is it's become so much more efficient where you don't have these mom and pops where there's, a lot of meat on the bone. It's truly, especially the multifamily sector, there's various other flavors in commercial real estate that are maybe less efficient than multifamily, but multifamily is very efficient. Okay. So some of these crises that you ran through, I want to educate our listener a little bit. And so when you're talking about the savings and loan um, crisis in the mid 80s, there was, and I'll butcher this for a second, you can correct me. There were tax incentives and tax shelters, the way the code was written, that a lot of people were investing in commercial real estate, multifamily, or even buying land and building these buildings just for the tax benefits.
True.
It was this tax shelter for ultra high net worth people. And there was a change in regulation that made that no longer so. And so you had this just glut of properties that had been built or in the process of being built that were no longer serving the financial incentive that they were made. And so they didn't make business sense anymore. And so a bunch of people couldn't afford them and had to get rid of them. Is that?
Yeah, well, you had it. Oftentimes it's a confluence. I used that word a minute ago of several things. One was the Tax Reform Act of '86, taking away all the tax advantages. Another one, what had been happening is syndication, and a lot of small mom and pop companies evolving to regional companies and even national companies, and really taking the development and investment business to scale in the '80s. And with the tax advantages, they raised a lot of equity, and they were just doing deals, building things that didn't need to be built. They were being able to provide tax write-offs to their investors. But then you also had an S&L in a lending environment where it was very excessive. People were getting loans 110% of the cost of the project.
Oh man.
So they'd close and walk away with money in their pocket. And so there was just this excess. And so it led to a huge deluge of units being built and delivered. And so this oversupply sounds a little bit like 2020 to 2022, where all of a sudden you have a very efficient market. We've gone through the GFC and we've gone through COVID, and everybody sees that multifamily is the top performing asset of all of them, with industrial and many warehouse close to it. But all of a sudden, COVID makes market the rents go to zero. Essentially, you have all this excess demand. People want to get multifamily, and you have free money, and so greed takes over. You can do no wrong, and you had a lot of people buying assets at prices they shouldn't have bought, and then they have this total greed mindset where nothing can go wrong. They're putting floating rate debt on loans that are 2.5%, 3%. It's really not going to float any lower, but no one really thought that through. And so when it inevitably changes, the people that have been involved with those excesses, they get caught. And that's where we stand today. We have a lot of companies in our space that own assets they overpaid for. They put floating rate debt on. Now interest rates are very high. They can't make their interest payments, and there's a lot of distress with those. Now the market's more sophisticated and efficient, so lenders are working with them differently than they have in the past. They look back now with hindsight, and they say that, hey, if we can hold this longer, the market will come back and we'll take a maybe no haircut or a much smaller haircut than overreacting and foreclosing on this immediately and taking it to the market. And really, for the last 2 years, we've had what I call the great pause, where you've had owners needing to sell, and they need those high prices. But with the current interest rate environment, it doesn't justify. You can't make them cash flow, so buyers want at a lower price. And there's been this big spread between what bidders will pay and what sellers are asking, and they're just standing at each other waiting, and no transactions have happened. And so transactions have dropped 70-80% in the last couple of years, and so it's been a big impact.
Yeah, that is one of those things. I mean, and there's been so much supply
Yeah.
that's hit the market, and I think of markets like Austin and really the major markets in
Mm-hmm.
Texas, especially. There's been so much supply that started when
Mm-hmm.
interest rates were significantly lower, and now we're talking about, of course, higher interest rates. Now we're talking about tariffs and the cost of construction increasing substantially, where there's a lot less supply down the road. In into 26, 27, beginning of 28. It takes a couple of years to build an apartment community,
It
and
does.
so that the supply runway right now is significantly less compared to the last couple of years, and
Yeah.
that's going to be interesting.
Yeah, because your low interest rates drove excess supply. So then we have this historic increase in interest rates, 550 basis points or whatever it was at the Fed. So all of a sudden, nothing pencils. So all of a sudden, you go from delivering a lot of units to the market to the brakes get slammed on and there's no units being delivered. But it takes 2 years to kind of conceive of a project, decide to go look in a market, find a site, go through entitlements, designs, bidding, and get ready to break ground. Then it's going to take you 22 months to build it, depending on the size of it. It's going to take you at least 12 to 14 months to get your clubhouse open, your first building, start leasing.
Mm-hmm.
And so you can't just turn it on immediately. So when things do look like they can pencil, by the time you start delivering units again, you're going to have a gap where the oversupply got absorbed. And now there's continued household formation, population growth, job growth, but you don't have any new supply coming in. So with that, occupancies will go up, rents will climb. And so we're expecting that in 26, we'll have better rent growth, 27.
Here's to hoping.
Yeah, that's right. It'll happen.
So
It'll
okay,
happen.
so you mentioned when you were describing the different companies that you have, there was a couple that I want to help
Yeah.
delineating what they do. And so you have a development company
Mm-hmm.
and you have a construction company.
Mm-hmm.
And so in layman's terms, kind of describe what is the difference in a development company and a construction company.
Sure. The development company is a company that conceives of an idea. In our business, we are exclusively focused on multifamily. So we are looking for markets. We track about 142 of them across the country. We're looking for locations where there is demand for additional multifamily housing, and where rents can pay for construction costs. You can make a deal pencil, and so we'll make a decision to go. Like we're working in Knoxville, Kentucky right now. We're working in Kansas City, and so we tried northern Colorado, Fort Collins. The costs were just prohibitive, but so we'll go find a site that we feel like is a good location for our product, a multifamily property. We'll tie up the site, purchase the site. We'll work with design team members to do the designs. We'll work with the city to get approvals, zoning and permitting, that kind of thing. And then a developer will hire a general contractor to actually do the construction. And then the developer will hire a management company to come in and do the marketing and lease up and management of it. And so so the development company does all that. That's Stellar Development Company. But instead of us going out and finding a third party general contractor, we hire our own company, Stellar Construction Company, to come in and build it. The construction company then takes the plans the developers come up with, and they advise on how to keep costs low. Then the general contracting arm of our company will go out to the market and work with the local subcontractors and vendors there in the market to have them price, the plumbers, electricians, the framers, that kind of thing. We'll get it bid out. We'll get cost commitments. We'll sign contracts with them. And let's say they give us contracts that equal $20 million. We'll turn around and then put our profit, our fee for a construction company on top of it, and sign a contract with the development arm, telling them we will build this property for them for that amount. Then it's the construction company's job to coordinate all those subcontractors and vendors to make sure, materials are delivered on time, the subs show up and do the work, the quality's there, so on and so forth. All the inspections are done by the local city. All the permits and all the approvals are achieved, and hand over a finished building that meets code and is in good shape. That's what the general contracting arm does.
So why have two separate companies? I mean, obviously, that's a sequential process with some overlapping steps. Why have two separate companies?
We like to keep business interests in different companies because they have different risk profiles, they have different personnel, they have different KPIs that we're trying to pursue, they have different financial needs, working capital needs.
Mm.
And so you could have a holding company and you could have divisions underneath. There's a variety of different legal structures you can put it in. But for us, we also want to shelter, from a liability standpoint, one company from the other. If something happens on the construction side, they can't, come against development because development had nothing to do with it, and vice versa, so on. Yeah.
Interesting. Okay, and then for our listeners, the next two, the asset management,
Yeah.
versus property management.
Yeah. So property management is the company that then puts people on site and they oversee the operation of the property. And so you're going to have obviously management personnel, maintenance personnel, you're marketing the property, you're leasing the property up, and you're dealing with existing residents and taking care of them and providing customer service to them and making sure that their needs are met. And the maintenance technicians are making sure the property's taken care of. If something breaks, they fix it, they mow the lawns. And so it's very much the closest point to the customer. We're making sure that property is marketed, leased to them, and we deliver the product that the customer, the resident, has paid his money for. And so that's property management. It's very operational. Asset management is really standing in between ownership and the property management. Asset management, sort of, so to speak, stands in the shoes of ownership, and their job is to oversee the asset from an investment perspective through its entire life cycle. And so asset management understands for us, our company will have an asset investment plan for each asset, and it'll tell, we'll have a plan. We're going to buy this and we're going to do this with it, and then we want to sell at some point, or we're going to build it and do this with it, and we're going to put a certain kind of loan on it, we have a certain kind of equity on it, and we're going to do certain things to it. Asset management is the keeper of that plan. And then they're the coordinator to make sure that plan is implemented, and they implement it through connecting with the management company to make sure they're implementing the operational tactical moves. Or if we're going to raise the rent to this, or if we're going to cut this expense, or if we're going to add a dog park, or whatever we're going to do. They'll also interface with our construction arm in case we're going to do a remodel of that particular property, make sure that remodel is executed well, on time, in budget, that kind of thing. But they're also going to look at the capital markets, and they may find that, hey, rates have fallen and there's a new loan program out there. It'd be advantageous to us if we refinance this asset. And that asset manager would come back to our investment committee and say, hey, this is what I think we need to do with this asset. We're on track with the investment plan, or we need to deviate because of X, Y, Z. And so they're very much kind of standing in the shoes of ownership, looking at it from a higher level, kind of the quarterback, so to speak, managing property management operations. And if you're doing anything physical, construction.
What was your degree again?
Finance.
Yeah. From Texas Tech?
Texas Tech.
Okay. And then did you get your MBA?
I went to Harvard afterwards. Yes.
Yeah. Okay. We got to touch that. Got to touch that. Harvard. How did a good old boy from West Texas find himself at Harvard?
Yeah, it's a proof that their admissions at Harvard can make a mistake. They let me get in. Mine was a mid-career certificate program.
Okay.
That I applied for. You had to have 15 years in the industry, and so it's a joint program between the business school and the graduate school of design, the GSD, and so it was specifically about real estate and real estate development, investments. And so, I was just very fortunate to go up there. I was certainly kind of a fish out of water in some ways, and they love to kid me about my twang. But that's my advantage. People tend to underestimate me.
Yeah. Hey, that's a great thing. Okay, so that was 15 years
Afterwards, yeah,
into your career.
yes.
Were you married at that point?
I was, and I had kids,
Oh man.
and actually, I got in a little early. They wanted that, but I had a couple references that had a lot of pull that I think helped me, and so actually, is about 11 years into it when I got into it. 2001 to graduate 2003.
Okay.
Yeah, and so wonderful experience, different world. Great network, powerful network, a lot of people doing a lot of great things. But I'm most proud of graduating from tech.
Amen.
Wreck
Amen.
'em.
Okay, so you were married, you had kids, you uprooted them to the
Yeah.
to the Northeast, and all of this is after 1989 when you had
Yeah.
started Stellar Hurt and Young. What walk me through that? Like how did you move there and keep your business going?
Yeah, what I did was actually the family stayed here, and I went back and forth. It was
Okay.
partial. It was on campus, and it was also distance.
Uh-huh.
And so I had to go and spend some time there, and I had to come back. And so I had twins that were young kids, and so it allowed that to work. And then I had great people working at the company that were doing a great job, and so that's kind of how it worked. Just
Wow.
had to hustle. You know, when you're younger, you
Oh
have the
yeah.
energy and you can do it. And you can stay up till 1 studying and that kind of thing.
My wife and I've said this, I think a time or two on the podcast. Our 20s, we called our med school season of life, where, I had 2 or 3 jobs the whole time. My wife was working. We started having kids at the end of that. And it just is what it is. You just accepted, hey, we're going to burn the candle at both ends, and it's for a season. It's not forever. And anyway, that's awesome. I did not know that you had a wife and kids whenever you were finishing that at Harvard. Okay, so you've seen a few things, going through.
I'm 57 now, so I feel like I'm getting old.
From the savings and loan crisis to the great financial crisis in 2008, COVID, whatever they're calling today's crisis. I'm sure you had some licks you took along the way. What's one of those, that you feel like you can talk about now, that you took a lick and were better for it and learned something from it?
I'm very proud, from a business standpoint. One of the things we're very proud of, and I don't know how long we'll be able to do it, but we've never lost a single dollar of our investors' capital in 35 years. However, I did venture into a project that was outside of my wheelhouse, so to speak, in 2005. And looking back on it, the first half of my career, I was motivated by a lot of wrong motivations.
Okay.
And this would be another podcast by itself. But, a lot of us, when we're younger, what's motivating us is not always healthy. And, insecurities can drive us. Pride can drive us. Greed can drive us. Those things. And my leadership, in my opinion, was poor back in the first half of my career. And so I launched into a project that was outside of our norm in 2005. And the project was very hard. We went right into the GSC, and we had to work very hard to get through it, and learned so much through that. But one of the biggest issues that drove that was I was leading in isolation. I wasn't asking the smart people around me the questions I needed to be asking. I was more making a decision on my own and saying, this is what we're going to do. And a lot of it comes from hubris. And so looking back on it and comparing today, very different in terms of leadership than the way I was back then. And, I wish I'd led that way back then. I would never done that project, and wouldn't have suffered the pain and agony of the challenge going through it. And so a lot of lessons there.
Yeah. Okay. You say different outside of your scope. What kind of project? Was it real estate or?
Yeah, it was real estate. It was just a master plan residential community that was going to be, a 10-year project. And I don't know what I was doing. It's not wasn't multifamily. And there's anytime you get in something new, no matter how detailed you are, there's going to be a dumb tax
Yeah. Oh yeah. Oh yeah.
that you pay.
Uh-huh.
And then when you go into a GFC where you had the second worst housing crisis since the Great Depression, that's not a good time to be in the market trying to develop lots and sell homes. And so it made that project very, very challenging for me. And I'm sure if I'd been leading collaboratively and relationally with my people around me, I'm sure they probably would have said, I don't know if we need to be doing that. And so you look back on those things and you learn from them. And today, I would say that a hallmark, couple. If someone said, give me one or two things that's unique about your company. I don't know if it's unique, but I would say number one, first of all, we are relational in our approach to leadership, and that's a whole nother podcast. But we are very passionate about loving the whole person, and whether it's about personal life or work life, we feel like a leader is put in a place to lead that person to their next greater good. And you need relational pocket change. You need to have trust. And to get trust, you've got to be vulnerable as a leader.
Mm.
A whole bunch of things there, but we're relational in our approach to leadership. And number two, we're collaborative. We really look down upon kind of a maverick approach by anybody or company making a decision and kind of just running with it. Now, that's not to say people can't make decisions and run with them. I'm always telling people it's always better to ask for forgiveness than permission, because I want people to be action oriented, empowered. But we usually get together in teams, and usually the best ideas are not mine. And usually they're not one person. It's a combination. Somebody puts together an idea, someone else has another, and then someone tweaks it, and then someone else throws something else on top of it, and you come out with something that's pretty well, thought through. And so that collaborative approach is harnessing and leveraging the collective knowledge and the gifts God's given those on your team. And so it's very different, that approach, than what I used to do.
Man, that's great. And our podcast is for the business owners, business leaders, and so much of what gives someone the muster or the I don't know, the courage to go out on their own is they're a self-starter. They're a do-it-yourself, pull yourself up by your own bootstraps. And there's like a level of self-discovery and maturity that you get to in your career where you realize, hey, I don't need to be the smartest one in the room. I don't need to.
It's best not to be.
Yeah. If I'm the smartest one in the room, I need to find me another room. But there's just a level of maturity in a completely different paradigm as a business owner, going from the self-starter doing everything to building a company. And that paradigm shift is really hard. It's hard for a lot of people, and it just takes humility. And a lot of times you got to put your hand on the frying pan, and that's the best way to.
Well, humility is a key, because we want self-starters, we want go-getters. I always tell people I hate pushing a string. You can't. I don't want to be telling people what to do. I want them moving and me trying to catch up. And I'd rather make a mistake than not take action. But you can still be a self-starter and move forward and be action-oriented and have a sense of urgency and leverage those around you by collaboratively working together on things. But your confidence comes from a knowing of oneself, a self-awareness, and a humility, so that you're not driven out of insecurity that you got to be the smartest one in the room. You got to be the man. You have to be the one that has the answer. It's okay to be wrong and someone else have a better product, but by gosh, you're going to push the ball forward. And you're driven. You have that sense of urgency, and you're not going to sit around and wait for someone to tell you what to do. But you'll submit to the fact that you don't know it all, and you're open and okay with not knowing it all. You're going to go get the smartest people around you. And so that form of leadership is the kind of leadership we're looking for: humble, strong, have a sense of urgency, hungry to make things happen. Um, that's great. The leadership is just self-driven because of insecurity or pride. I got to be the man, or greed. That's going to end up in trouble eventually. And that was me early on in my life.
You've built something that I'm proud for you,
Mhm.
and something that your kids working with you, and just the respect that you have in the community. You've really built something incredible at Stellar, and for you now, I'm curious, like looking back over the last 35 years, what's one of those moments or those wins that you look back and you're proud of?
The wins that I'm most proud of, well, there's thankful and there's proud. There's so much thankful. It's innumerable. I couldn't cover all of it, but I'm thankful to have learned and grown personally and been able to change. It's hard to change a lot of things that are baked in you. You kind of come out naturally that way, and learning how to manage yourself. And I love the idea that it's never ending. There's a book called "What Got You Here Won't Get You There,"
Mm-hmm.
and so there's this idea that what got me to this point this year in 2025 is not going to get me to where I want to be in 2035. And so I had to be learning and moving and evolving. And I love that. So it keeps me hungry to learn as a person and get better. And so I'm thankful that I've been able to grow. Um, I'm, 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 s- I'm really proud of people that I've seen around me that have done great. I have some people who have worked for me as interns, and they've done great in the business. They've gone on to other companies, and um, that's where I started. Steve Hurt took me under his arm, and he taught me not only the business, the trade, but he taught me what being a good person was about. He's a Christian believer, as I am, and he connected Scripture to work, and I'll never forget it. It was a paradigm shift for me. I start applying this stuff that I've been, supposed to be reading. I wasn't at the time. And so, the impact he had on me, I feel an obligation to pass that on and try to lift others up. So I've got people who've come in, they've interned, and they've gone on to other companies, and they're doing great. That gives me great satisfaction. And then I've got some of them who have stayed on and they're still working with me. And so I think looking forward, that's what I'm most excited about, is seeing that generation, um, the 20s and 30s-year-old guys and girls, um, growing into their own. And I feel like it's not a zero-sum game. It's either me winning and you losing, or vice versa. With them, I feel like it's the pie's going to get bigger, and we can all do better together. And I love seeing people grow and us winning together. So.
That's great, and that perfectly flows to the next question is what you've built. You're in 4 different states right now, 26 different markets. Is that what you said?
Not actively now. We've worked in 26 markets. We're probably in about 13 or 14 markets right now.
That's crazy.
Yeah, it's fun.
That's yeah. That gets you up, and
Yeah,
every day is different, and there's new and unique and fun problems to
yeah.
solve. What does Stellar look like 10 years from now?
I think we'll continue to do what we're doing, but we'll probably expand our geographic focus. I'll be in Knoxville next week, Kansas City in a few weeks, but we'll probably do more and more through, the number of states we work in. And so we'll have a larger geographic footprint. We have some superstar young men and women that I think they're going to really come into their own. My goal is going to be to be more of I want to beat the drum about our principles and our values and overall direction, and work hard to give away territory and let others come in and take that. I think universally in business and even in ministry, the old lines don't want to give up their territory, and it's hard to do. But you need to give up your territory to those coming in underneath you, or else they'll go find that territory somewhere else.
Yeah.
And so, and then when you give it to them, you don't need to reinvade it. I've done that many times. But the key is in continuing to give them space to grow. And I think people are probably ready sooner than we think they are.
Mm-hmm.
But that's what I see in the future. Hopefully, we're run by a leadership team of 6 individuals, and then we got several others in other areas that are very strong. And I'm looking forward to seeing them kind of do great in their life.
Man, that is fun. And so humility, I say that over and over about you, that giving them their own territory. And sometimes I took it over and I shouldn't
Mm-hmm.
have. And that's just experience and learning and self-discovery and continuing to work on yourself and get better. And man, the team you built, I'm like,
Mm-hmm.
Drew Gray is one of my favorite people
Yeah.
in the world. And man, and that's just, I know you're a humble guy and don't take credit for the man that he is, but man, you've done so much to make a man, to help
He's special.
build up a man like that. And your kids are like working with you and in and around the business now. And that's the dream. That's what I want for me and I don't know what that'll look like in my future with me and my boys, but I just that's one of those I want to learn from you over the years. And man, how did you navigate that?
Well, and it's interesting. Drew came to me. I can still see in my mind's eye the day he walked in my office and had blue jeans and boots on, and he was a young kid in college needing an internship so he can check off a box for grades, and luckily the professor sent him to us. And now look where he is. He's our chief investment officer, and so but he had the raw talent. He had the raw goods. He just needed a little help, and he is a spectacular young man. And I've seen him pour into other interns, and he's passing it on, and even into my kids. And I believe that life can be both and, not either or.
Mm-hmm.
In other words, I can have family members work with me, but we can have key employees who are partners like Drew Gray or Shane Bright or a Dylan Donald or whoever at my office that are on the leadership team. It's not my kids on the leadership team. It's other people. And, you can have both. And so we aspire to make sure we want to create an environment where the kids have to perform and they only have to be there if they want to be there, and then they're not going to take away opportunities from others who want to be there and do great. And the two can work together, but we're very intentional to try and anticipate where the problems can be. And we talk a lot about, we believe in designing the alliance up front. And again, that's where that relational leadership model is so critical, so that everybody knows your heart and you can go where you need to go together, hopefully. And then I think, for us, we have a spiritual focus in our business, and we're very active. We have what's called Stellar Life. Life is an acronym, living in faith every day. And so we have an on staff, a lot of people would call them chaplains, but we have some personnel that's all they do is the spiritual side, Stellar Life. And we have one that focuses on our corporate team, and we have a focus on our on-site teams, and so we're doing all kinds of things with that. And then our newest endeavor is we have a gentleman, Daniel McGraw, that's running with, we're doing ministry to our residents. And, there's a lot of brokenness in the world,
Mm-hmm.
and including with me. And so how do we point them in our business? You don't have to believe the way we do to join our company, but we as leaders of the company want to point them to Christ, and we believe that we can do well while we're doing good, and it's not mutually exclusive.
Yeah.
And so we're pursuing profit, but we want to make an impact on people's lives that we believe would be eternal, which is more important. And that gets me charged up, where we're having a class in one of the properties, let's say one night, where it's Christian financial concepts and trying to help people figure out how to do a budget and manage their money. No one's ever taught them.
Yeah.
Or maybe a little workshop on marriage and family, because anybody been married very long knows it's not easy, right?
Yep.
And so that's what we want to do. If we can impact them, that makes a big difference. And our purpose, we have a statement that says, "Being about our Father's business, being building the kingdom of God." We can't require people to believe that, to come on board, but we do ask them to get behind our mission, which is 4 words: invest, develop, serve, impact. And we have a little sentence we put together. We say, while we invest in real estate, we develop our people to serve others in a way that makes an impact that matters. We do ask them, you've got to get behind that, or you don't need to be here. Had to believe our faith, but at the end of the day, we want to make impacts while we're doing our business. And that kind of gives me the motivation to be involved in what we do. It's not just about dollars. It's so much more than that. And so that gets me up every day.
Man, that is inspiring. We want to be useful,
Yeah.
I want to be useful for the kingdom, and I'm a, round, or I'm a square peg looking for a round hole. I only have a certain skill set, and in the kingdom, in the workplace, it's hard to, justify that with our current culture and our current, narrative that business serving a purpose for the kingdom is such a real intangible thing. If you can, obviously hold it with an open hand, and have an ear to listen, and a heart that's open to what the Holy Spirit is saying. Man, that's powerful. I really, really appreciate you sharing that part of your business.
That's the most exciting part of my day, when I'm having a one-on-one with one of my direct reports. I have one every week with each of them. And sometimes we never get around talking business. We're talking, how's your weekend? What did you do? How's your family? How's your wife doing? She's been sick. How's that going? Or they may ask me something. And there are opportunities sometimes to speak into it. And people don't feel comfortable doing it. But, you just start somewhere, and then over time, if you're willing to make yourself available, and you're willing to have someone tell you no and don't worry about it, all they're going to say is, "No, I don't want to talk about that." Or I remember the first time I asked somebody, "Do you mind if I pray for you?" I was scared to death. And, I've only had it maybe a couple times someone say, "No, I don't want you to do that." And that's okay.
Yeah.
And so, we just each do our part. And at the end of the day, that's all we can. If we did our part, if we did our best, at the end of the day, we can be proud of that. And that brings me a lot of gratification.
Man, that's good stuff. Yeah. All right. I think it's time for a fire round.
Okay.
All right.
Let's see them. How rapid are you going?
Paul, what is your favorite movie?
My favorite movie is, I had to think about this last night, but I think my favorite movie is The Miracle. I'm sorry, not The Miracle. I like The Miracle. It's Cinderella Man.
Oh, yeah.
I just love it. It's a true story. Man overcomes hardships. And it's just an inspiring story for me.
Is that Russell Crowe?
Yeah, Russell Crowe, boxer, true story, Cinderella Man. I love it. Great.
Okay. What is aside from the Bible, what is your favorite book?
Yeah, I was going to say the Bible. I got one that's kind of technical, and so it's not like exciting to read, but I found it's very helpful. It's called Multipliers, and it's about leadership. And the idea is that some leaders multiply the people around them, their capabilities, and grow them, while some leaders are diminishers, and they squash the output from the people underneath them. And what are the things that leaders do that either bring out the most and best out of people, versus what do they do to diminish their people? I just found it to be a very helpful book.
Okay, man.
Multipliers.
I've never read that. I want to read that one.
Yeah.
Okay.
Yeah.
What is a common piece of advice in your industry or in business that you hear that you don't agree with?
I think commonly I've heard now over 35 years and 4 down cycles, 3 or 4 down cycles, that every time someone's going, well, I think it's different this time. Things are different. It's not going to go down because of such and such and such. It's never different. Things go up, then they come down. And you have to look for the excesses and be careful. Another one I heard on a podcast, a gentleman in my industry said, floating fixed rates are for suckers. And I just thought that was for me, not wise advice. The whole industry, a lot of the industry has used floating rate debt. I've always been a fixed rate debt guy. I like to fix it and go to bed and sleep at night and not worry about what it's doing every day. And I think just general, the concept of, and this ties with our relational approach to leadership and our faith, the idea that, keep personal at home and keep business. And the separation of two, I think, is a big lie. You can't separate the two. Most of the times when we have problems with someone's performance, over 50% of the time, I'd probably say 70% of the time, there's something going on in their personal life that's driving some of it. And so those are kind of three things that come out at me.
I love it. All right. And then if I wanted to send people your way to do business with you, how do they get in touch with you?
Probably email me, be the best way.
Okay.
It's paul@thestellarfamily.com.
paul@thestellarfamily.com.
Yeah, paul@thestellarfamily.com. So they could reach me there.
Awesome, man. Thank you so much. This was great.
Yeah.
You had great stories. I knew you wouldn't disappoint. And so thank you. I really appreciate it.
Hey, thanks for having me.